Hi, good evening, everyone. Hope you can hear me.
Yes, sir.
Good evening, everyone.
Good evening, sir.
Yeah. So we are starting now, but we don't have time. I've sent, I believe by now, you should have been used to not to be using African time. 8:30 is 8:30, right? Because I know that once it's like 9:30 now, fatigue setting, and before you know it, people start to doze off or log out. That's why we are starting on time. We don't have the time. Okay. So the last time we met, right, we were discussing the substantive procedure for current assets. We've done that of non-current assets. We have done part of the current assets. We were looking at inventory before the class ended. That was where what we were discussing. So substantive procedure as it relates to inventory, right? So I'm going to continue from there. Now, one thing that we need to note here is that the substantive procedure, like I said, cut across every aspect of the financial statement, right? So we are looking at the statement of financial position, and we are looking at inventory. We started it last time. That was the last time I took us. So I'm going to continue from there. If you need further clarification on how inventory started, substantive procedure, you can fall back on the last video prior to this one. Okay. So let's continue. So we're looking at substantive procedure for inventory. We have talked about we have looked at so this is where we are, right? So substantive procedure for inventory is therefore focused largely on existence and valuation assertion. Remember, we said that the financial statement assertions, you need to test them when it comes to this uh, inventory, right? And what are the relevant assertions, financial statement assertions that we need to test? We need to test existence, we need to test valuation, okay? You need to test that, right? You also need to test completeness, rights and obligation, and under presentation and disclosure, you need to test that one to that it is and properly disclosed, because when there are issues with inventory, let's say there is a discrepancy, we need to put it in the notes to the account. That's where presentation and disclosure assertion will come in. Okay. Now, remember, we said that in IAS2, under IAS2, said that inventory can be valued at lower of cost or net realizable value, whichever, right? And I know that I've also talked about the difference between the two, right? So we talk about cost. So when you talk about cost, when you're valuing inventory at cost, it means that you are looking at it from the angle, the point of what? Purchase, okay? All the cost in bringing the inventory into a present location or condition. That is the cost, okay? All the freight cost, right? All the raw materials that you use, right? All of this that you put in place to bring the inventory into its present location and condition is derived at cost. Why the net realizable value, like I said, is what you are going to derive when it is being sold. Okay, when it is being sold in the ordinary course of business, that is after you have produced a product, you need to sell them. So the how you derive the price. Okay, that what we are looking at. You can either value inventory looking at it from the angle of cost, or you look at it from the angle of the net realizable value. Okay. Now, if you're looking at inventory quantity, the physical count. Now, remember I said that one of the ways you need to, one of the assertion we need to test for inventory is existence. And how do you test existence of inventory? Is by performing inventory count, right? So what are the things you need to do when you are performing inventory count? Now, remember, inventory count is an activity. It's an audit activity that is being conducted or being performed to be able to ascertain the quantity. Even sometimes can use also to ascertain the value of those inventory that are stored or kept, whether in a warehouse or in a store. Okay. Now, what you need to note here is that the essence of this inventory count is to be able to ascertain, is to satisfy that assertion that the inventory actually exists. Okay, that's what you are trying to get. All right. Now, you also need to ensure that the counts are done correctly. because the accuracy of inventory records is very, very key when it comes to stock count. The only essence of you performing the stock count is to corroborate what you get at the stock count with what has been posted or recorded in the statement of financial position as inventory. You know, if you know that what you have in your statement of financial position as inventory is usually your closing stock. Okay, I believe you all know that is your closing stock that you post in your statement of financial position. Okay, now what you also need to note here is that the inventory count, there will be need for you to decide as an organization together with the auditor and decide on what methods do you want to use in doing the count. Do you want to be doing it at the end of every year? You want to be doing it periodically. You want to do it at intervals. If you are doing it at the end of the year, that means that you are doing it at the end of the year. That is the year-end stock count. You are doing it at the end of a periodic. That's what you call the one that we do mostly at during month end. We call those one periodic counting. Okay. Now the perpetual one is the one you do at intervals. That is what they use in supermarket. At supermarket, okay, or retail outlet, they cannot afford to do year-end stock count or to do periodic stock count. What they will be doing is the perpetual, okay? What they will be doing is what? Is the perpetual, which is the like continuous. It has to do with what? Continuous counting, because you cannot wait until when the year ends or where the month ends before you have to be doing it as it occurs. So that's why you can be able to track the movement in your inventory, okay? Now, there are times when you are going to have variances in your inventory. That's the essence of that. So at the end of the stock count, you should be able to reconcile three things. You should be able to verify the accuracy of the stock count. That's number one. The one you counted physically. Number two, you need to reconcile what you have counted with the bin card, because the bin card is a document, is a store documentation that records all the receipts issue, that is the movement in the inventory. That's the document you use to record it. So whatever you have as the stock balance in your bin card, supposed to tally with the physical count that you have done. That's the second one. Then the third one is that your physical count and your bin card as they tally, right? It is also necessary that what you have posted or recorded on your accounting system, whether an accounting package or an accounting ERP, also agrees with this other two. That's physical count, the bin card balances, and the system balance. That's what you have on your accounting package or on your accounting ERP that is being utilized in your organization. So when there are variances in either of these areas, there will be need for further audit procedures to be performed. We need to investigate the reason why the basically the reason why the variances occurred in the first place. Okay. Another reason why you also carry out inventory count is also accounting the status of those items, because in some manufacturing organizations, right? I've worked in an organization before, right? We do stock count every month end, but as we are doing the stock count, because it's a manufacturing organization, we are we are we are intentional about the stock count. What do? We also take the manufacturing date and the expiring date of the product, because we know that the product have different expiring period, okay? And we know the shelf life of this product. So we are trying to reduce deterioration. We are trying to reduce wastages, because if these items get expired in our warehouses, that is a loss. Okay. So what we do is that when we are doing the stock count, we ensure that we are intentional about it. We take the manufacturing date and the expiring date of these products, so that by the time we are doing the analysis of the physical count using Excel, more importantly, right? By the time you do your sorting, because you have captured it based on manufacture date and expiring date, you need to sort the ones that are about to expire, so that the management can take decision on those ones that are about to expire. For instance, when you have items that are about to expire in the next couple of months, what do you do? Since you are aware of this, you are aware, what do? You push those ones out first. You are going to push those ones out first so that they don't expire in your store. Because if they expire in your store, it's going to affect your bottom line. That is your profit. You understand what I'm saying? That's what you need to do when you are doing this stock out. And so these are some of the procedures you need to And when you are doing stock count, right, there's a need for this set of people to be there. You have the store personnel, you have the account personnel, you have the internal audit and external audit will be there for observation purpose. Okay, they will be there for what? For observation. While the accounts department personnel and the store personnel will be fully involved in the what? In the counting and recording. Okay. So the essence of the external auditor and internal auditor being there is to ensure that there are no items or inventory that are omitted. Okay, to be sure that there are no inventory that are omitted during the count, and to be sure that all what are needed to be counted have been included. Okay, now so when the stock count is about to be done, there are procedures you need to follow. Number one, you need to ensure that the products are properly arranged. The inventory is properly arranged. That's number one. You need to be sure that the warehouse or the store where the inventory are kept are properly marked. Okay. You need to mark them. Marking them means it's easier for you to identify in case you want to come back to verify the balance in the inventory. You can go to that spot and get because you have already marked the area. Okay, you have marked the area. For instance, not that you are marking with asterisk, you are marking it with number. Okay, there's a way you mark. Okay, so once you are able to mark it, then when there's any contention or any discrepancy in the count, you can go back to that particular point which was marked and recount and recheck again so that you're able to ascertain the true value, I mean the true volume or the quantity that you have in that inventory. Now, one thing you also need to note here when you are going for stock count is that as an external auditor or as an internal auditor, you need to have the stock balance before the stock count begins. You need to have it so that at the end of the stock count, you are going to now compare the stock balance before the stock count and the physical count that you counted. Okay, so if there are variances there, you might need to go and recheck and be sure that those variances are not fictitious, and the variances have been confirmed to be real, there will be need for additional audit procedures to be performed to investigate on the reasons why maybe there are some inventory items that have not been captured, okay, or omitted. All right, so all of that will be looked into. I hope that is clear. Then this is one I was talking about, the annual count, which you done at the end of the year. You have the one that is done at the end of reporting, we call it periodical count. You have the one that is done continuously. Okay, that's the one that is being done in the supermarket. We call it perpetual accounting. Okay, now we're talking about audit work relating to inventory count. Now, the main financial statement assertion addressed by the auditor's attendance of the inventory is what is existence. I've said that, okay? However, the audit work at the count, either before or after the count, will also generate evidence relating to the valuation. You're able to know at the end of the stock count, you're going to, after you have counted the quantity, you're able to, value them. Okay, you value what you have as your inventory. You need to also understand who is the owner of the stock. Does the stock belong to you or they are kept in your warehouse by another party? Okay, then the auditor also needs to ensure that all the processes that needed to be done before the stock count begins are done. Okay, and even after the stock count has ended, that they may ensure that everything has been properly done. All the parties that were involved in the stock counts that they actually sign off on the sheet that they use, okay? Sign off on the what? On the sheets that they use. So we have an example here that we can use to also further explain what we mean by it, like a typical ICAN question that can use to explain how we talk, what we mean by substantive procedure in inventory, okay? So you're a senior in charge of audit of inventory as spares are lost. Inventory is comprised of large quantity of spare parts for the car industry. Spares are lost operates a perpetual inventory recording system backed up by a rolling program of physical counts throughout the year. There is no year end. There is no year end physical count, and the amount of inventory in the year end financial statement is based on computer records. Required. Summarize the procedure that would undertake to obtain evidence on the amount of inventory in the year-end financial statement. This is a typical ICAN question. First of all, you need to understand what do you mean by perpetual. You remember I made mention of something that time we are doing. Perpetual is a continuous count, okay, at a variety of dates during the period. And that's why I said that that's what you make use of when you are when you're operating a supermarket or a retail shop. I hope you understand where we are going now. Now, we now ask you to what? Briefly summarize the only procedure that would undertake to obtain evidence on the amount of inventory in the year-end financial statement. Now, like I said, any time you hear of audit procedure, that means that you have to go step by step. Okay? That you have to do what? You have to go step by step. If you miss any of those steps, then the examiner will be willing to what? To deduct some marks for what you're supposed to have gotten. Okay? So, what are the only procedure? Number one, you need to carry out spot checks during the year. Why do we carry out spot checks? Now, look at the question. It said inventory is comprised of large quantity of spare parts for the car industry. Spares and us operate a perpetual inventory recording system backed up by a rolling program of physical count throughout the year. So they do the stock count, but what we are saying here is that they will need to reascertain, okay, to confirm that there are no material misstatements in the stock. And that's what they are going to do. They are going to do spot checks. Spot checks are impromptu arrangements. You will not inform anybody, you just turn the store and say you want to carry out stock count, okay? You catch them unawares. That's what we mean by spot checks, okay? You need to also conduct sample counts at the year end, compare the perpetual record and investigate any variance. So what that means is that at the year end, when you are done with the stock count, right, you need to compare what you have in what you have in the stock count, the year end stock count, and the record that is being kept by the storekeeper, okay, for the perpetual record, for perpetual counting that is being done. So you have to check that. And when there are variances, there will be need for the auditor, okay, to investigate. Now, you also need to check a sample of cost prices to purchase invoices. You need to take sample, okay, from your invoices, okay, and try to see whether there had not been any instance of maybe omission or maybe sometimes you can have suspicious invoices. You need to be careful of that. Then you also need to assess obsolescence. What do you mean by obsolescence? Obsolescence occurs when a stock item value depreciates or value reduce as a result of a new technology or a new update. We call it obsolescence. For now, let me give an instance. So for those of us, the iPhone users amongst us, right? iPhone 17 or iPhone 18 will be out shortly. I don't know whether it's out already. Now, and if anytime iPhone 18 or 17 comes out, the last version that you have, I think it's iPhone 16, the price automatically what drops because the demand for that iPhone 16 will drop. Knowing fully well that as an individual, a rational individual, we always want to go for new things. So the price of the new iPhone 17 will go up. Why the price of iPhone 16 will go down? Why? Does it mean that iPhone 16 has reduced its quality? No. But it's just that because of the advancement in technology, because of the advancement in the product, so the users we tend towards to go for the latest version as against looking at the one version that is remaining. That is that most of them will now try to do a trade-off. It's just like cars too. Okay, motor vehicle. Every 6 months, a new model of vehicle comes out. So you have Toyota Corolla 2026. I think it should be available now. So by February next year or by March next year, you'll be thinking of another Toyota Corolla 2027. So as the new Toyota Corolla is being released in the market, the older version 2026 prices will automatically what drop because a rational individual always wants to test what new things. Okay. That's what we mean by obsolescence. You need to also consider the use of all this software on the year-end inventory file. So at the end of the day, when you are done with the inventory count, right, you need to deploy your audit software. Your audit software has capability of analyzing. By the time you upload all your worksheets, I mean all your stock count sheets, you upload it on the software. You can be able to analyze because you have set a prompt there that you compare the physical with the system balance. Okay, from there you'll be able to watch. You'll be able to analyze and get to understand where there are variances, and you might need to do what um, perform additional procedure to unravel what you mean by what led to the what to the variances. Okay, so any questions so far? So that's the answer to that question. If it comes on answer, that's the answer to that question. Any questions so far? Any comment?
No question.
All right, thank you. Now, what you need to note here is that in the process of performing inventory counts, right, there is a need to ensure that there are no there are no control weaknesses. Because, like I said, the essence of the stock count is what is to validate whatever inventory balance you have in the same financial position. So, if there are internal control weaknesses in the organization, in the client's organization, automatically is going to impact negatively the inventory balance you have in your financial position. All right. So what are some of the measures we need to put in place so that we prevent some of these weaknesses in the internal control system during stock counts? Number one, you need to pre-number your worksheets. That is the stock count sheet. You need to pre-number them. Why do you need to pre-number them? If you pre-number them, it will be easy for you to analyze at the end of the day. But if you don't or if you don't number them, you can duplicate, you can mix them up. Especially if you have not written them in the order that's supposed to be done for easy analysis or identification. You can mix them up. And when you mix them up, automatically it's going to translate to increase in your fictitious increase in your inventory balance or fictitious uh, reduction in your inventory balance at the end of the day. Okay. And you also need to ensure that when you are doing your stock count, you need to use the count sheet for each inventory. For instance, let me give an instance. So you went to a factory where they produce Hollandia now, for instance. You know we have Hollandia Evap. That is the evaporated milk of Hollandia, the smallest pack. That one that is how do I call it now? Like triangle shape package for a VAP that sells for 200 or 250. Then you have the VAP of a bigger size, right? Then you have another one that's bigger than that one. What we are saying here is that you work in an organization where they produce a VAP and you want to do stock out, you need to first of all arrange your inventory in this that are uniform on the same side, the same area. So that when you are taking the count, you are taking likes, inventory that are what? That are similar, that are the same. You shouldn't mix your evap Hollandia milk with the evap of let's say of 500 or 4 or 300 mil of the same evap. You know what I'm saying? Or you say you now model up Hollandia with Hollandia yogurt. Hollandia Evap and Hollandia yogurt, they are not the same, they are from the same manufacturer, but they are not the same products, right? So when you stack Hollandia evaporated milk and Hollandia yogurt on the same side, then when you are doing the counting, there could be what? There could be mixed up. So you need to avoid, that's why we talk about proper arrangement of inventory before the stock count. It's highly essential, okay? Then you need to enter quantities counted on the stock sheet. They should ensure that they don't enter the quantity counted in pencil. Why should they not enter in pencil? If they enter it in pencil, it's going to do what? It can be easily erased or easily adjusted. But if we have written it in pen, using pen, if there's going to be any adjustment, you are going to see the traces of what? Adjustment or cancellation, which you might trigger some questions, okay? So you shouldn't use pencil. That's another control weakness that can be avoided if you use biro, you not use pencil, okay? Then you shouldn't use only the store staff, store personnel during the stock count. Why? If you use only them, they are aware of where there should be shortages. They can easily hide or not to report any shortage of variance. That is the reason why you need to involve the what? Other department, like the accounts department or the internal department to be there, okay, to corroborate or to validate whatever counts that the store personnel would have provided, okay? Then there's need for the inventory areas, okay, to be what? To be marked. What I said, so that if there's any discrepancy on any of the products, you can go back to the marked area and recount or and recheck, okay? Then at the end of the day, another strong inventory control that needs to be put in place is that when the count has ended, every individual that participated in that count must put down their name and sign off. They must put down their name and what? And sign off, okay? Then you need to also ensure that all the personnel that are involved in the count have been properly briefed on how they go about the count. So that when you now get it, you are now counting haphazardly. You are well informed on how you go about the count, okay? So these are the measures that need to be put in place to guide against any weakness in the inventory count, okay? Now, you remember inventory, you remember for those of us that did accounting at the rudimentary level or elementary stages, there's what we call manufacturing trading profit and loss account, right? Now, in that particular account, that was where they described to us the components, what makes up the inventory. The inventory has what? Three main components. It has the raw material, it has the work in progress, and it has the finished goods. Those are the three components that makes up the what? The inventory, right? So for an auditor, right? When you are doing the count, you should be able to segment your counting into raw material, work in progress, and finished goods. You shouldn't model them up, okay? You do what? You do model them up. Because the raw material, the way you are going to value those ones, right? You are value those ones at what? At cost. At what cost did you buy the raw material? That's what you are going to use to value that, okay? So you need to look out for the bill of materials. That's what you use to purchase the raw materials, okay? When you are done with the count, first of all, you have to segment them into what? Raw materials. You have to count them separately, okay, according to the components of the raw materials, right? Then you now use the what's it called, the bill of materials to use to value the materials that has been purchased, okay. They also need to ensure that at any of these either of these stock inventory type, whether raw material, work in progress, or finished goods, you ensure that you either use um, first in, first out method when you want to pick those items, or you use what? Weighted average, okay? Weighted average cost, okay? First in, first out, or you use what? Weighted average cost. What does that mean? So if you have bought raw materials at different times in a year or in a month, right? You bought some at 500 naira, you bought some at 750, you bought some at 1,000 naira, raw materials. At the end of the period, you want to assess what will be the valuation, what will be the costing of that inventory. You cannot use 500, you cannot use 750, you cannot use 1,000. What are you supposed to use? You have to use what? The weighted average cost of the inventory. You need to aggregate the three costs, that is 500, 750, 1,000. Look for the average. That will be your average cost that you're going to use to value the inventory at the end of the period. That is what FRS, IS2, that's what it recommends, okay? Then I'll talk about this, all right? In the case of the work in progress is raw material that is being about to be converted into what? Finished goods. So when you are doing the stock out, there are some raw materials that they will have been transformed to what? Work in progress, okay? Now, when they are transformed to work in progress, right? There is a need, okay, for the auditor to perform the following tests. Number one, it needs to obtain schedules showing the makeup of the cost value of each item of work in progress and finished goods. You need to be able to obtain what? The, the schedule showing the what? The makeup of the cost figures. How did you arrive at the costing of those items? Okay, you need to look the request for what? The schedules showing the makeup of the costing figures for each of the work in progress and finished. Number two, you need to recompute. You remember what you did in audit evidence and service chapter 6? You will compute the what? For you to be able to what? Verify the accuracy of what has been captured or what was presented to you. You need to have that attitude of what? Professional skills to do what? To recompute. Okay, it's one of the measures to obtaining audit evidence. Remember, we look at this in chapter 6. All right. Then you need to also perform some test audited transactions, okay, on the raw materials and check the correct quantity of materials have been used in the evaluation. So what that means is that you need to take samples, okay, of the raw materials that you have counted, okay, or you have used, be able to ascertain that for the valuation, just a sample of them. For instance, you might have different components of raw material. Just take a sample for each of them and try to aggregate by taking the word average, okay, for you to be able to determine what the valuation will be. Then also, you remember that when you're talking about um, when you're talking about cost of an inventory, right? I will still go back to that manufacturing to invoice and loss account. There are three costs that are directly related to production. We have we call them the prime cost. We have the direct material, direct labor, and we have what? Direct material, direct labor, and direct expenses. Those are the three components that makes up the prime cost. If you remember so what I'm trying to say is that there's not knowledge that you have learned before that is not useful. Okay. So if you are using if you are for raw materials or work in progress that you are going to use, you are going to value using cost, you have to factor in this cost elements, direct material, okay, direct labor. How many staff have you used to produce? Those are the staff. The staff we are talking about are the workers, the factory workers. They pay them what? Wages. They don't pay them salary. They pay them what? Wage. Because they are working for what? They are working in line with maybe hourly, or they are working in terms of the number of batches they can produce. That's how they pay them. So that's what you are going to compute. So it come under what? Direct labor. Okay. They have some direct expenses. Okay. Those are some expenses that are attributable to the production. You have to factor all of this in. All right. Those are what you are going to use to calculate or to confirm what your the valuation of your work in progress will be. All right, what your work in progress will be. I've talked about cost or net realizable value earlier, right? I said that you have talked about it, so I'm going to skip that. Then we'll go to the next one. We go to substantive procedure for trade receivables and prepayment. Any question on inventory? We are done with inventory. Any question on inventory? Any question on inventory, please?
On, sir.
All right, thank you. So we go to substantive procedure for trade receivables. Now, trade receivables is the same thing as debtors, right? The same thing as what? Debtors. Now, what do we mean? Now, remember that debtors or trade receivables are or is part of the current asset that is contained in the financial position. Okay. Now, what are the principal risks that are attributable to trade receivables? Okay. When you have trade receivables, what are receivables? Let's start from there. What are receivables? Now, receivables are sales that have been made, okay, inventory that has been sold, but the funds from the inventory that has been sold is yet to be collected. That is, when you make sale, when you don't collect when you don't collect the money immediately you sell. If you collect it immediately you sell, we call it what? Sales, cash sales. That's where the sales is completed. But when you defer, when you postpone, when you allow for period for them to make payment, I mean to pay, okay, before you can generate revenue from the sale, they are talking about what? Receivables. All right. So receivables has risk. What are some of the risks that you face when you account for receivables in your financial statement? What are some of the risks you face? Okay. Now, number one, sometimes the receivable can become what? Irrecoverable. It turns to what? Bad debt. What is bad debt? Receivables that cannot be collected any longer. We call it bad debt. Number two, another risk that you can face with receivable is that customers might deny, okay? They want to contest that money that you said they are owing. These are customers that have not paid for what you supplied. I mean, for what you delivered. They have not paid for it. So some of them don't give good records. So by the time you now ask them for them to make payments, they'll not be content that no, I'm not owing you up to this amount I'm owing you. Start seeing some of these issues. Okay. Now, other risk that you face when you keep receivables is that there's going to be what we call a cutoff issue. What do you mean by cutoff issue? Now, you sold, what is cutoff? Remember, we look at cutoff as an assertion under audit evidence. We say cutoff is what? Ensuring that you record transactions in the period that they occur. You record transaction in the period that they occur. What does that mean? That is, if you make sales in May, in the month of May 2025, right? The receipt, that is the revenue you're going to generate from that sale, should also come in the month of what? May. But if you make sales in May 2025 and your revenue for that sale is coming in June or even in August 2025, then that means it has what? It has failed the cutoff assertion because it will not what? It will lead to what we call material misstatement in financial statement. You know what I'm saying? So that's what is going to happen. So there is a need for the auditor to always test this assertion cutoff. Okay, you made sales because you go to IFRS 15, what did it say about revenue? It said revenue, IFRS 15 talking about revenue with contract. What does it say? That the only time an organization can recognize revenue is when the revenue is earned. When it is what? When it is earned. So until when you receive money from the order that you have fulfilled, that you have delivered, that is when you can say you have completed the what? Sales. It turns to what? Revenue. Do you understand what I'm saying? Then also, another thing you also need to find is that sometimes also you might also have to test for the income statement assertion. Okay, under income statement assertion, you have the assertion based on transactions and events, right? Where you have the occurrence, you have to verify that those sales actually occurred. Because sometimes you might have fictitious receivables. Yes, just to make the financial statement to look so presentable, they will create fictitious receivables. You have to confirm that those sales actually what occurred. As part of the assertion, you're going to test on the assertion based on what? Transactions and event that relates to the statement of profit or loss. Okay? Relates to what? Statement of what? Profit or loss. Right? You need to test all of these. These are some of the risks that you face that is attributable to what? Receivables. Okay? Now, how can you verify whether the receivables are genuine? How do you verify? The way you can verify is by using what we call what? Confirmation. You need to secularize the customers. What do you mean by secularization? Now, data secularization is a procedure in audit that is used by auditor to validate, okay, to validate the balances of the customers with the balances recorded in the statement of financial position. Okay, in terms of what? Financial position. I hope you understand what I'm saying. So what am I trying to say? If the client management has included or has recorded trade receivables to be 1 million naira in their statement of financial position, It's the duty of the auditor, external auditor, to validate that that 1 million naira that is recorded in the same financial position actually exists. How can he verify this? The way we can verify this when he carry out what we know as what debtor secularization. Now, I know what the secularization means. That is another procedure whereby the auditor writes the customers, okay, to provide the balances that they owe the client. But he must do so with the authorization of the client management. The client management must provide support in terms of what? Ensuring that when he's sending that, uh, when he's secularizing the customers, that the auditor uses the what? The client letter paper, because we need to write them officially like a letter, okay, asking them to what? To furnish the balances that they owe the client. All right. So the secularization can be of two types. You have positive secularization and you have negative secularization. Now, positive secularization states that is a procedure that says that the customers, whether whether they agree, whether they agree or they disagree with the balances, whatever balance that they have, they must provide. Whether they have balance or they don't have balance, for positive, they must provide. Okay? Whether they have balance or they don't have balance, they must provide what balance whatever they have in their book. For instance, so a client, the customer owes the client management, the organization, let's say he didn't even owe at all. Okay, he did not owe. Or let's say he owes like 500,000. Okay. So, but what they have recorded in the books, in the customer's book in the company, is, let's say, 700,000 naira. Do you know what I'm saying? The company has recorded 700,000 naira. The customer A is owing 700,000 naira. But when they secularize the customer said that what you owe me is what? He responded and said what? It's 500,000 that I owe you. Okay? When he does that, when he responds, whether he agrees or he does not agree, but he responds to the confirmation to the letter that was sent, the separation that was sent. That is known as what? Positive secularization. Okay, that was known as what? Positive secularization is here. This is a positive confirmation request, asks the customer to reply to the auditors whether or not they agree with the balance in his account, that is in the client company's accounting records. That's what I just explained. Okay. Where negative secularization is a convention that requests that the convention that requests only that the customer should only respond if they disagree with the balance. For instance, the client, customer B, owes what? 500. But the auditor has written them and said that what you are owing this organization is 500,000. And in his own record, he has 500,000 that is owing. He does not need to respond. But let's say the company record say that he owes 500,000 naira. But in his own books that he keeps, he said that he owes 350. That means there's a disagreement. That's the only time he's going to write back the company. That is what we mean by what negative secularization. Okay, because you can call it negative secularization, you can call it negative confirmation. Is the same. Okay, either one you call it negative secularization or you call it negative confirmation. You are saying the same thing. Okay, that's what you mean by that. All right. I just need to explain that before I forget what I'm trying to say in that regard. Now, what you also need to note here is that, like I said, the main essence of the main assertion you'll be testing under trade receivables is what? Is existence. Okay? You're going to test existence. That is one that's very, very paramount. Then also, you might also need to test other assertions. That is the right and obligation assertion as well. Right? Remember, I said that right and obligation assertion also relates to the statement of profit. Relates to the statement of financial position. Now, what does it mean? Sometimes you might have discounted the receivables. Somebody is owing you. you have you have you have involved a discounting company that will buy the receivables off you. What do I mean by discounting company that will buy the receivables off you? So you know that some customers are owing and they are long overdue. Now you want to save yourself the headache. You want to clean your books. What do? You consult some companies, we call them discounting companies. They will buy off your receivables off you. For instance, let's say the value of your receivables in your books is 1 million naira. They say that we are going to buy it from you at 900,000 naira. What have you lost? You have lost 100,000 naira. Now, what have you done? What have you done in this regard? Number one, you'll be able to clean your books. Number two, you'll be able to transfer that risk. The risk that is going to lead to what? Irrecoverable, bad debt. You have transferred it to them. So whether they were able to recover the money from the customers or not, it's no longer your problem. You have transferred that risk. You know what I'm saying? Now, that's the essence where you need to look at the value. You need to ask questions. This value you have here, does it belong to you or is it discounted balance of your what receivables? You need to ask. That's where the right and obligation will come in. Who owns the balance? Does the balance belong to the customer or is it discounted value that you have negotiated with the debt recovery company or discounting firm that you have traded off the receivables to? Okay. Another thing you need to ascertain is the valuation. You need to establish how much are they owing you? How much are the customers owing your organization? There must be a value attached to it. All right, you need to test that. You also need to test cut-off assertion. You need to test of cut-off assertion. Okay, you need to test that those receivables actually occurred in the current year under review. They are not the one for the prior year or the comparative year. It's for the year that you are reviewing because sometimes they could be manipulative. Okay, very well could be what manipulative. You need to check that those receivables are actually for the year. By the time you circularize all the customers, all of this information will be at your fingertips. Okay. So the requirement of ISA 505 as regards to receivables is that the auditor should maintain control over external confirmation requests. That is, you need to decide on information to be confirmed, right? You need to decide on the what? The confirming party. For instance, like I said, they are using a debt recovery company to recover your receivables. The auditor need to confirm if that information is actually true and who is the person. Okay. They need to design the confirmation request. Okay. That is, you need to write a letter to them. Okay, including an instruction for responses to be sent directly to the auditor. Okay. Then you need to so after you have collated all the response, you need to aggregate it with what you have, compare it to what you have in your financial position. If it's the same, then there is no issue. But when there are variances, I will need for the auditor to perform more audit procedures, okay, to investigate the reason why the variances occur. All right. Now, if the management refuse, sometimes management will not will not grant the auditor the right, okay, to secularize the customers. When that is done, when that is refused, if the management refuses the auditor to secularize the customers, then the auditor will need to do the following. First of all, you need to inquire from them why they don't want the secularization to be done. You need to ask why don't they want secularization to be done? Okay. Number two, you need to the auditor will need to also tell them that there are implications where they don't allow for secularization to be done. That means the auditor cannot validate the value of trade receivables that is contained in the financial statement. That might need the auditor to do what? To qualify his audit opinion. Based on what? Limitation of scope. We are going to look at reporting shortly, okay? Based on what? Limitation of scope. All right? So this is the only procedure that the auditor needs to follow when he wants to perform secularization, okay? You want to perform what? Regularization of receivables, okay? You want to confirm what you have as receivables. Number one, you need to plan the confirmation exercise. That's number one. Planning the confirmation exercise. You need to know what it needs to do. What will it be involved in the planning? decide on the timing of the confirmation. Okay. They need to also in other plan, you need to decide on the number of customers it needs to work to confirm. It's not everybody. You need to carry out a sample. Use your sampling, okay? You need to decide on confirmation method to use. Is it using positive or negative confirmation, right? Then, after he has done that, you need to go to the second stage. That is what? You should now collate, decide whether it's going to use what? Positive or negative confirmation. You need to collate the information that he has obtained, whether using negative confirmation or is using what positive confirmation. By then, after he's done with that, you will be able to aggregate the value under positive confirmation, the value under negative confirmation, depending on which of the options he has opted for during the secularization. Okay, and whatever he gets, he's going to compare it with what he has in his what in his the balance that the management has recorded in statement of financial position. Okay, that's what it's going to do in that regard. All right. I've talked about negative and positive confirmation. I've talked about that. Okay. I've talked. So that's all. That's all for. Okay. Let's look at other audit procedures that can be performed. So those are the main ones you are going to do. What are the other audit procedures that the auditor can perform for trade receivables? Let's look at it. Okay, others they can do. Now, the auditor we need to verify, okay, and review the company's procedure, that is the company policy, okay, for irrecoverable or doubtful receivables. That is, the client ought to have a policy that addresses how they account for bad debt or doubtful debt in their books. Okay. Then the other we need to review, these are other procedures aside from circularization. Number two, he needs to review and list the receivable balances. That look at the total receivable balance. How many customers are we? What is the value of what they are owing? For how long has this outstanding receivables been? How long? Is it 1 year? Is it 2 years? Is it 3 years? Okay, you need to be able to ascertain the period at which the receivables has been outstanding. That what we mean by review aged or aged listings, okay, or receivable balance. You need to ascertain that, okay. Then you need to also need to ensure that the recoverable receivables and allowances for doubtful receivables you only relates to overdue accounts. So you understand what I'm saying? There are times when you make sale. So sales that fall within 2 weeks, sales that fall within 1 month might still be under allowable period. But those sales that fall within 3 months, 6 months, 1 year, those are long overdue. Okay? Those are the receivables that are long overdue. So there should be policies that guide against that. So it shouldn't be any money that is being owed that will be accounted for as in recovery. We should be able to categorize them into those ones that fall within normal period and those ones that are overly outstanding. Okay, you need to also look at that. Then the author should also review any correspondence with the client company, with customers. Okay, for instance, there could have been instances where some customers have written have written the company, the organization that they are disputing the figures that you say I'm owing. I don't owe up to that. Okay, I don't owe up to that. That could also be those are some of the things that we'll also be looking out for. Okay, and sometimes the company in their magnanimity they can say that okay, you can pay 80% or 90% of what you are owing, we are going to give you discount on the remaining one. You also need to look out for that. If there are such calculations that have been provided for, and that have been approved. And sometimes also there could be the customers might be giving a credit note saying that you can pay within 2 months or 90 days. You can pay within this period. We are going to get a waiver on whatever you are owing. For instance, let's say you are owing like 1 million. If you can pay within 60 days or 90 days, you pay 950 as against 1 million. That was only by credit discount, okay? You know, we have credit discount, we have trade discount. Credit discount has to do with that. For trade discount, you're looking at quantity, giving inventory. For instance, okay, if you buy something of 1 million, rather for them to say, okay, they will now give you additional item. That's what we mean by trade discount, okay? But this one is credit note, okay? For you to have agreed to pay early, rather for you to pay 1 million, they can ask you to pay what 950,000. Okay. Then the auditor will also need to review the replies from customers from confirmation of balances exercise for evidence of receivables that may not be collectible. There are some that's the risk of trade receivables. That is, they can turn to what bad debt. Bad debt means they will not be recoverable any longer. All right. This is another example. Let's look at this example. It could be an ICAN question, right? The following, the following is a summary of the year-end receivables balances at Mike's manufacturing and revenue figures for the previous year. So these are the customers, right? Jones, 2024, he owed 2005. 2023, he owed 2004. Smith, 6,000, 2024. 2023, 3,000. Brown, 2,000. 2023, 3,000. White, 1,000. 2023, 1,000. Crane, 20,500. 2024. 2023, 18,900. Other customers, all with balances under 1,000. This is the value. 16,600 and 7,400. Okay. Then you have Brown went into liquidation during the year. Brown went into liquidation during the year. The one that owes 2,000 went into liquidation during the year. Right? Set out which of the balances as a minimum the user should select for testing and explain why. So this is an example that I want us to what to try. All right. I'm going to I'll attempt it now. All right. But in your own time also, in your own leisure, you can also try it on your own, okay? Now, what they are saying here is that Brown is here. Brown owes 2,000. Say that he has what? His company has what? Liquidated. That means the money has turned to a bad debt. We're not be able to what? To collect the money any longer, okay? Now, set out which of the balances as a minimum the auditor should set for testing and explain. So if you look at this, right, you can use anyone. What they are saying here is that from all of these customers, select any of their balances, okay, as the minimum, okay, and explain why you have chosen it to test for receivables, whether the receivable can be what can be collected. That's what they are asking us here, okay. So you have a customer that owes 20,500. You have one that owes 6,000. You have one that owes 2,500, okay. When they're not asking you, if you want to select anyone for testing, tell us the one we are going to, they say as minimums, which of this one we are going to use as minimum, and you tell us the reason why we are selecting one of it, and you're going to explain why you have chosen that particular balance as a test. Okay? What do you do? For me, right, I might go for this one, 20,500 and 80,900 that relates to what? Crane. Why did I select Crane? Now, although Crane I'm looking at what maximum. So I will expect that you all try minimum. I'm using at it for maximum because crane is the only one that owes more than 20,500. Others they are less than 10,000. But for crane, you owe 20,500 and 18,900 respectively. Why did I choose this? I see that there is a risk that this particular customer it might not be able to pay up everything. You're not able to recover all the receivables from this customer. Why? Because bulk of what you're supposed to have as a revenue is outside. Bulk of what you have as a revenue is what? Is outside. For me now, if I want to do this thing very well, right? If I want to answer this very well, I'm going to use what? Ratio analysis. I'm going to place this, I'm going to place this 20,500 over this one, this total that you have there. I'm going to use what? An analytical review procedure. So what is 20,500 divided by the total of which is 48,600. So that means train owes 42% of what is outstanding or what is regarded as what trade receivables in the books, in the financial statement, 42%. And what that means is that if this money cannot be recovered, it's going to affect the business. If this money cannot be recovered, it's going to affect all the business. So that 20,500 is represent 42% of the trade receivables for year 20x4. Why 18,900, right? 18,900, 34,300 represents 55% of the trade receivables of the previous year. So what that means is that this constitutes what a big risk. That is to collect these receivables might become what might not be realistic at the end of the day, because if as at 2023 he owes 18,900 and 2024 it has increased to what 20,500. That means that he's still buying more and the company is at the verge of what losing this money if they don't put in place a strong internal control system, such as ensuring that there is a stringent credit policy. Okay, credit policy. That is, this customer, they should not sell anything to the customer until he makes the payment, or they can ask him that he will enjoy some discounts if he can pay back what he owes to the company. That is the way I would have answered it. And I said, I'm looking at it not as a minimum, but what? As a maximum. So for you, class, I will appreciate if you can look at this example you have here and look at it from the angle of what? Minimum. I have explained from the angle of what? Maximum, okay? I've explained from the angle of what? Maximum. So I expect us, others, right? The class, try it using the what? Minimum. Minimum is what? All these ones are minimum. 2005, 6,000, 2,000, 1,000, all of them, those are minimum. So look at it and provide your own justification. I will appreciate if you can send your solutions to me personally, okay? Any question before we proceed? Question, comment?
John chapter 2.
Yes, I'm with you.
Because your love for each other to really.
I'm with you. There a question? Does anybody have a question? Please respond. Any question? Are we good to go? All right, we go to the next one. We are done with the receivables. Okay, so starting procedure for receivables, trade receivables. We are going to the next one. The starting procedure for prepayments. Okay, what are prepayments? What are prepayments? These are expenses or prepaid expenses. These are expenses that have been what? That have been paid for in advance, even before you enjoy it, even before you incur it. You pay for the services in advance, even before you what? Before you incur it. We call them prepaid expenses. Okay? We call them what? Prepaid expenses, right? Now, prepayments are not material and so may not justify significant audit attention. Okay? Now, the substantive procedure on prepayment may include the following. Number one, obtain or prepare a list of prepayment with supporting calculations. So for instance, your ISP, your internet facility, internet expenses is usually on prepaid, right? Usually what prepaid. Your Electricity also, and also the what prepaid. You paid in advance, right? Before you use it. Now, you need to obtain a schedule for all of this and looking at what this calculation, how you arrive at it. For your internet, you know it's charged per what? Megabyte per second, okay? Megabyte per second. That's how they charge. For your electricity, they charge per kilowatts. Okay, they charge per kilowatt. Okay. For band A that I know in some states, right? They charge as high as 225 or 209 per kilowatt. Do you understand what I'm saying? So all those calculations, you need to put it somewhere. Then number two, you need to check the calculation if the list has been prepared by the client staff. You need to check the calculation if it has been prepared by the staff. Number three, you need to apply analytical procedures. Okay? What do you mean by analytical review procedures? You compare what you have in the previous year. For instance, let's say this is prepayment now. Let's say this is the prepayment. This is for the current year, this is for the previous year. You compare. By the time you compare this year versus last year, what you are doing is known as what? Analytical review procedures, okay? Then you need to review the list of repayment for any previous error or omission based on auditor's knowledge of the business. So you need to ask, has there been any error? For instance, let's say your ISP supposed to pay for 3 months, you paid for 6 months, right? The invoice they give to you is for 3 months, but you are paid for 6 months, right? You need to look at some of those issues, right? If there's any. If there's any, right? That's what you need to do. So for the audit of prepayment, there's no major attention. Why? Because it does not constitute any major risk. Okay? The risk, the materiality of prepayment as regards financial statement is very low. That's why there's no much attention being placed on prepayment. Okay? Then we'll go to the next one. Substantive procedure for bank and cash balances. All of this, remember, they still fall under what? Current assets. Prepayment is under current assets. Bank and cash also falls under what? Current assets. Okay. Now, this is bank and cash. They are susceptible to what? To fraud or theft. Okay. They are high risk compared to repayment. Okay. They are high risk. So Asset held as bank balance and cash can be at risk of loss, okay, which is evident, which is obvious. There may be fraudulent activities or misappropriation of money by employees or others, particularly when many individuals have authority for dealing with receipts and payments. What does that mean? That is, there is no assigned person that should be accountable or responsible for signing or approving what payment. Everybody can approve. All the managers can approve money. When such are allowed, or such is allowed in an organization, that means fraud is evident, it's possible. You know what I'm saying? Okay. Now, however, bank balances and cash are also readily checked and what verified. So that's why you need to also perform the uh, existence assertion on that, okay? You need to confirm that, okay? How do you confirm the existence transaction? You need to look out for what? For the bank, you need to request for what? The bank certified bank statement. There are bank statements, there are certified bank statements. So the auditor will need to write the client bank, to furnish or to present a certified bank statement that is stamped, because we all know that bank statement can be what? Can be forged, can be tampered with. When you ask for a certified bank statement, you compare what the banks, your client's banks, have given to you with what you have in the what? In the accounts department of your client. The bank, you compare both of them, you know whether there are variances there or they are the same. Okay? Why for the cash, you perform what? Cash counts. You perform what? Cash count. What do you do? What do you do when you are performing cash count? You are performing cash count, you are trying to ascertain and confirming that what you have counted physically is what has been recorded in the statement of financial position as the cash balances. Okay. Now, the principal risk that you have with bank and cash is the risk of misstatement, which can be attributable to knowing fully well that not all bank balances owned by the client are disclosed. There are times when you have some clients, they have more bank accounts. You may have like 20, but on the face of the financial statement, they only present maybe 5 or 15 out of 20. Okay. Then sometimes reconciliations are not done. Bank reconciliations are not done. That's another way. You don't know, you can't ascertain how much goes in and how much goes out. Okay, it becomes an issue. All right. Then you have material cash balance are omitted. So sometimes they maybe the management, right? They utilize some money. They were giving some money to carry out to carry out some transactions or expenses on behalf of the company, right? But they have failed to furnish the account department with all supporting documents to back up those transactions. So that's what we lead to what we know as what in, incomplete information that will now be tested as what a completeness assertion. Because in accounts, you only post, you only record when there are documents. There are no documents, sometimes it becomes very difficult to to record. Okay. Those are some of the risks that can be faced when you are dealing with bank and cash balances. Okay. Now, the presentation and disclosure assertion is low risk at the disclosure. Why? Because bank is what is straightforward. You only say what you are going to disclose is that you have verified the bank. You have requested for the what certified bank balances. Okay. I mean certified bank statements. Okay. And also perform what? You have performed cash counts to verify the balances you have in what? You have in the cash in the safe, okay, with the customer. All right. So the bank certified statement is what you have here. Okay. The auditor must that the auditor will write the bank to confirm whatever balances that they have, and that the balances are contained in the certified bank statement. Okay. So the auditor can use two approaches, okay? The auditor, method one, the auditor lists information about the bank balances from the client accounting system and asks the bank to confirm that the balances are correct. That is, the auditor will go to the client accounting software or accounting ERP, look at the balances and request the bank to confirm that these balances are correct. That's number one. Or number two, the auditor will write the bank separately, independently. All right? That is, the auditor requests confirmation of the relevant bank balances without providing any details to the bank. You will guide them. And then, can you furnish me the account balances of this my client's accounts? Those are the two ways you can use. Okay. The essence is that you are trying to ensure that you are trying to validate whatever balance that is being kept in the what in the books. All right. So this aspect will be taken by the other facilitator. The second facilitator will handle this aspect. It's the procedure for payables. Any question? So with this, we are done with the substantive procedure for my own part. The other facilitator will look at the introductory aspect of substantive procedure and this aspect, trade payables, okay? Does anyone have any question? Any comments? Any question,
None.
comment, observation? We are good, right?
None.
Thank you very much. Thank you. So we go to the next one. We are going to reporting now, okay? Now remember that in under reporting, before we go to reporting, we have looked at audit evidence, we have looked at planning, right? Now we're going to reporting now. Now, what do we mean by reporting? Now, reporting is the last stage of the audit engagement, okay? Reporting is the last stage of the audit engagement. When you are doing engagement, when you are performing an audit engagement, you start with what? Planning. You plan the audit. You obtain audit evidence. That's number two. You evaluate and review the audit evidence that you have obtained. And the last stage is what? Reporting. Okay. Now, under reporting, before you go to reporting, there are some other subtopics you need to look at here. The first one is what? Written representation. What do you mean by written representation? Written representation is the same thing as what? Letter of representation. Then you call it written representation or you call it what? Letter of representation. Okay. Now, what is this? What is this known for? This is one of the documents that is utilized during an audit engagement. This is one of the documents that is utilized during the what? During the audit engagement, okay? It's a written statement by management provided to confirm certain matters or to support other audit evidence. Sometimes, let me tell you how you utilize this. So the auditor is, is asking for information, trying to obtain evidence. The management is not forthcoming with the evidence. What will the auditor do? The auditor will now write there, I need this information. Why are you not giving me this information? What will you do? The management will now write and say that this is the reason I cannot give you this information. When the management writes the reason why they cannot give that information to the auditor, that will serve as what? A written representation. Do you understand? It serves as what? A written what? Representation. What are the objective of what are the objective, okay, of the auditor as regards written representation? Number one, obtain written representation from management that it has fulfilled its responsibility in respect of financial statement and the audit. So once the management presents that information that, okay, this is the reason we cannot give you this information, it's a sensitive matter, we cannot give it to you. That will form part of the evidence to show that I've asked this question, and in future, if there's any issue that may arise, right, the auditor will not be culpable. The auditor will not be held responsible because he has done his best, and this was the response he got from the what? From the client, okay? Number two objective, obtain written evaluation as appropriate to support other audit evidence. Sometimes you might have obtained some evidence, but you needed this information, this document to provide additional support, okay, to the already obtained audit evidence. All right, for instance, you carry out a stock count. You discover that there are some variances there. You're now asking them, these variances, could you explain why you have this variance in raw material? And management will respond and say, this is the reason we have variances. So what they have given to you is that they have corroborated, that they have accepted that number one, there is variance, and number two, that this is the reason for the variance. Do you understand? Or you might support. Number three, all right, respond appropriately to representation provided by management, or if the management, what this one means is that sometimes management might be obliged to provide responses, and sometimes they might not feel the need to work to provide responses. But what the auditor needs to do is to ensure that you request for this information. Okay. Now, the relevant standard for ISA, I mean, the relevant standard for rating representation is ISA 580. So ISA 580 addresses rating representation or letter of representation. So it requires the standard, rating standard requires appropriate rating representation for management. That is the management that is responsible for providing the representation, not the auditor. All right. To be in form of a letter of representation addressed to the auditor, that's what I said. The letter is usually addressed to the auditor. Okay. Now, this rating representation may be an important source of audit evidence. I've said it earlier. By the time they provide the information, the auditor will take it as part of his own supporting documents as regards what audit evidence. Okay. So all of this is trying to explain what I meant by how I explained the written representation. What you have here is explaining what I mean by written representation. Okay. Now, such a so at what point do you require written representation? Why do you need written representation? Or what instances would you require written representation? Number one, when you want to support the auditor's understanding of management's intention or judgment, when you want to support the auditor's understanding of management intention or what, or judgment. For instance, in respect of future plans of the company, of the business, or a specific matter such as net realizable value of inventory. I give an instance. In this stock count, you had a variance there. They gave you the explanation. So as an auditor, you have a better understanding of why the variances occurred in the first place. Okay. Number two, in respect of the completeness of a specific item, that is, sometimes the information that is being provided by the management will provide a complete, will serve as what? An evidence that a complete information has been what? Has been requested for. So there's no, the author will not be assuming, okay? The author has a what? the final word from the management. Okay. However, although such written regulations provide necessary audit evidence, they do not provide sufficient appropriate evidence on their own. That is, you cannot rely solely on the on the written regulation alone. It has to be backed up by what? By other audit evidence. It cannot stand on its own. Okay. Now, if a representation by management is contradicted by other audit evidence, sometimes management will give creating an organization that does not tally with what the auditor has at hand. Okay, what should the auditor do in such instances? When the management, you are asking for, this is why there are variances in raw materials, and what they are, the responses they are provided to you does not hold water. What should you do? Okay, number one, the auditor should consider whether his risk assessment of the area is still appropriate. That is, when you discover that what the management has given to you does not correspond or cannot validate what you have already, what do? You need to reevaluate the whole audit engagement. Okay, you consider whether you need to perform additional audit procedure. You have to consider whether you need to perform additional audit procedure to be able to have a reasonable level of what assurance. Okay, then it also is an indictment on the integrity of the management, because when you cannot rely on information being provided by the manager, that means their integrity is at stake, and that can lead to so many things. Can lead to later to qualify his audit opinion. Okay, now the auditor is also required by SA 580 to obtain certain other specific organization for management. Okay. In this organization, the management acknowledges that it has fulfilled its responsibility for the preparation and fair presentation of the financial statement in accordance with the financial regulatory framework. What they are saying here is that one of the reasons, one of the objectives for the management is that it makes them to confirm, right? To ascertain the fact or to confirm the fact that as far this engagement is concerned, we have provided the editor with all necessary what? Information. We have provided the editor with what? All necessary what? Information. Now, what you need to note here, and I need to say it here, is that the written representation, like I said, is written by the management, yes. But technically, right, in the real world, the letter of organization or written organization is usually written by is written by the auditor on behalf of the management. Why is that so? Now, the reason is that, let me shock you, right? Auditors always prepare for always have at the back of their mind that the management will need to give certain information at some point of the engagement. That at some point, the auditor will request certain information from the management. And the management will deliberately delay in giving that recommendation. What will the auditor do? The auditor will usually have a draft response that management might give for not giving certain information to the external auditor. Do you understand? At any time the external auditor is going to carry out an audit engagement, he has a draft of the possible responses management might provide for not giving certain information to the external auditor. What will you do to the client? To avoid waste of time, the auditor requests for what? An, a letter paper, a new letter paper from the client, and he will type that response on the client letter paper and give to the management or the client management to what? To sign off. The management letter what? Signs off. It's like saying now, I gave you a blank check that I've signed. I gave you a check that I've signed. Or I gave a blank check to you and said, I sign it. Go and withdraw the money. Once you sign it, it means that you have authorized it. That means you can go and what? Withdraw the money. Because that means I've given you the money to go and withdraw the money. You know what I'm saying? So the data is usually written by the auditor. But what now happens is that the auditor has a graph, and now to save time, you will request for the client letter paper where it's going to write the draft and present to the client management or to sign off. Because the client management sign off, and because it's written on the client letter paper, we always say that this is a letter that is written by the client. Okay. Now, some of the information that you might see in a written organization is that number one, a written organization letter relates to the audit of the client company. You see that statement there, okay? You also see another one. The management of the entity has fulfilled their responsibilities for the preparation of financial statements. The financial statement gives a true and fair view, and they are free of any material misstatements, okay? Number three, it contains assumptions made by management to make accounting estimates and reach fair values are reasonable. Then another one, content of the letter of relation representation. Related party relationship and transactions have been what? Have been disclosed, okay? The next one, all events after the reporting period have either been adjusted or disclosed, okay? Have either been adjusted or what? Disclosed, okay? The next one, the effect of, sorry, the effect of any uncorrected misstatement, they will explain the effect of any uncorrected misstatement. The auditor has provided with all relevant material, including the books of accounts and unlisted assets to the individuals within the entity. All right. So all of these are what the manager would have imputed in the what? In the letter of representation. And they will sign off and give it to the auditor. Okay. All transactions have been recorded and are included in the financial statements. Okay. The management have disclosed to the auditor all the information that is relevant to fraud or suspected fraud. They can ask this question: what are some of the information that are contained in the letter of representation or in this representation? These are the answers, okay? They are going to list all of this, right? Then the management have disclosed all known instances of non-compliance with laws or regulations that relates to the preparation of financial statements. The representations may also be included that refer to specific assertions in financial statements if the auditor requires that such assertions should be what? Should be made. Where the manager refuses to provide a written organization, right, the auditor will discuss with the management why the reason why they don't want to provide the information. Then also an avenue for the auditor to reevaluate the integrity of the management as regards whatever information they are obtained from them. And there will be need for you to reconsider the impact of on other organizations and audit evidence. The auditor can also what? Qualify the audit opinion. Okay, the auditor can also do what? Qualify the what? Audit opinion. Okay, those are some information that you have in the what? In the financial in the written representation. Okay. Now this next one, evaluation of material misstatement. This is ISA 450 that talks about evaluation of material misstatement. Okay. Now this auditing standard identify during the audit requires a list of uncorrected misstatements to be attached to the letter of representation. All right, such as a list of such a list is often referred to as a summary of unadjusted audit differences. Okay, a misstatement could be in relation to the amount, classification, presentation, or disclosure of an item. All right. I hope we are together. So that's what we mean by that. So let's go to any question before we go to audit report proper. Any question? Any comment?